G'day folks, welcome back to another upgrade for high-grade copper and US crude oil. Now both charts are showing cautiously bullish momentum on the daily time frame. We'll include some backtesting which demonstrates how you could have traded one or two strategies, so don't forget to hit that like and subscribe button to support the channel. In terms of the outlook for US crude and Brent, despite rising OPEC production by 411,000 barrels per day in July and expanding non-OPEC output, inventories remain subdued and refinery margins healthy, anchoring prices near $63 to $66 a barrel. However, a forecasted global surplus, weak demand growth and looming contango in 2026 may pressure prices toward the mid-US dollars, $50. Geopolitical risk, US, Iran, Canadian wildfires offer upside, but forecasts from Goldman, JP Morgan and EIA target Brent in the near $62 to $70 per barrel this year, with downside risk below $60 if global growth falters. High-grade copper, structural bull market remains intact, surging green energy demand, EVs, renewables, clashes with constrained supply due to underinvestment and limited mine output. Prices are supported by falling London Metal Exchange inventories and stock tightness, with analysts expecting a shortfall of 180 to 250 kilotons in 2025-2026. Forecasts range from US $8,800 to $10,100 per metric ton, US $4 to $5 a pound, with potentials to challenge resistance around $5.27 a pound. Bull case see heights towards $6.15 a pound if deficits persist. So looking at the long-term trends first off for high-grade copper, on the monthly we're showing a bullish momentum with the prices above the moving averages, likewise the CCI. Notice back here we did have a bearish divergence now versus high highs on the price. Now if you look closely, that wick of that candle straight after it broke down into that retrace level. So if we drew a retrace of our Fibonacci range, you can see there that candle the month after penetrated that 23-38% quite easily. So that's now played out. Let's mark that. And it looks like the CCI is now moving in line with the price again. On the weekly, it's also had this bullish break to the upside above the moving averages of the CCI, and it was already above the moving averages of the price, so giving us bullish momentum. Notice as well, I've got here drawn some fair value gaps. Now the fair value gap, basically that pink area there and these blue areas, the way you calculate that is you look at the previous, if you look at that candle in the middle there, that bearish candle, you take the candle before and the candle after, and you draw a range between that, the low of that wick to the high of that wick. And that pink area there is what's called a fair value gap. And what you'll find happens is often the price will retrace back into that area to fill orders that haven't been filled. Back here, for example, that also broke down about the 30% level before bouncing out of there. Likewise here. Sometimes they break right through it. You can see there that one covered the whole range. This one broke right through. This one only covered about probably about 30% of that. And this one, this next candle broke down to about the 50% level. So again, those fair value gaps I'll be covering as well moving forward where they exist. So at the moment, as I said, bullish momentum on and a fresh breakout on the CCI on the weekly. On the daily, if I zoom in here, you can see there we had another fair value gap that broke up and filled that area and actually went past that 100% retrace. There's no divergence that I can see. There's a small fair value gap there. Again, we can't tell where it is from the current candle, but based on that candle there, the candle after it and the candle before it, you can see there from that high of that wick to the low of that wick is that little range there. It's a bit hard to see, but that's a fair value gap. So you might see a bit of a pullback into that range to fill those orders. Another fair value gap here was filled quite easily. This one here was filled a few days later by that candle, and so on. You can see there I've got a few drawn there, and all these have been filled. Now if we go to the intraday chart, we always look at the micro level, so we look at for any divergence here or any fair value gaps. So longer term here on the 1 hour chart, we had a long time frame wise, we had a bearish divergence versus higher highs in the price. And the way you measure that, again, if you're new to the channel, we take a Fibonacci, we take it back to the recent low, significant low before the divergence started. And if I was to draw a range of a target area, it was at 23-38% range. And that was the 23-38% of that Fibonacci range. Also, I've marked here as well the fair value gap currently in that range. So you can see that after that divergence started, that red candle broke into it almost immediately the next couple of hours. So that divergence is played out. Now this could actually, you'll notice here we've got this fair value gap, this pink area or the red area. So we're very likely to see the price move into that area. The CCI is still not bullish, it's still in that moving average range, but we expect at some point to break above that moving average into that fair value gap. As well, we'll see the CCI break higher as well. Another fair value gap there, you can see went straight through it. Another fair value gap there, you can see that range broke down to about the 50% level, and then it bounced out of it again. So always pay attention to those fair value gaps. Now if we look at trading strategies, we look at the stop loss approach up here and the average down approach. And the way we enter these, we look at the higher time frame. So if you're trading on the 1 hour, we look at the daily. So what I've got back here around about the, where was it? About the 20th of May on the daily, when the CCI broke above the moving average, and so did the price, we take long positions on the stop loss approach and the average down. Now the stop loss approach, had you let it run through the whole period, and I'm not suggesting you do that, you close out the positions when the CCI on the daily breaks into the moving average range like it did there. So ideally, if you see there on the right, on these charts, you would have closed out the position on the hourly at that point there, and you would have gained $529 on the stop loss approach. And at that point, you would have gained about $4,043 on the average down. You averaged down a few there, had a bit of a drawdown, and that's why the profitability was so high. Then as soon as the daily broke higher again, with the price and the CCI above the moving averages, that's where you re-enter the trades. And that's where you would have re-entered about there. But if I let it run through the whole period, and you would have let it run through there, the whole period generated about $1,450 for the stop loss approach and approximately $11,800 for the average down approach. So looking at US crude on the monthly, we're below our moving averages on the price and also below the moving averages on the CCI, giving us a bearish momentum. Notice as well here, in terms of fair value gap, we've got a little fair value gap there, so very likely going to see the price break into that range, if not break through it. So, but again, I'm not telling you to buy based on that alone. We need to look at the overall trend, and at the moment the overall trend is bearish. On the weekly, the CCI is broken into the moving average range, giving us a neutral position, but the price is still below the moving averages. So if you're trading on the, whatever time frame you're trading on, always trade on the higher time frame. So if you're trading on the daily, we always look at the weekly. If you're trading on the weekly, we look at the monthly, and so on. So here we've got we had another fair value gap. Now you notice here it broke to about the 25% range, and it broke down. So that could have actually filled the orders that were in that fair value gap. But again, we'll take it one step at a time. This could actually keep rising and fill that whole area. Notice up here as well, we've got a fair value gap, which hasn't been penetrated yet. I'll mark that. So that goes from the high of that candle and to the low of that candle there. So that's a fair value gap, which hasn't been filled yet. You can see all the other ones in there, the pink and the blue ones highlighted, or they're all been filled. This one is partially filled, so we'll consider that a fill, but if that needs to penetrate that area, we're going to see it go through that fair value gap as well. So again, bearish to neutral on the weekly in terms of trend. On the daily, now it's been stuck in this range between a support at 55.20 and resistance at around 64.15. And what we had here, if I zoom out, we had a bullish divergence versus a double bottom on the price, and that's actually broken up into that Fibonacci retrace level. There are, again, here's some more fair value gaps. Those haven't been filled yet, so I'll mark that there. I'll bring it right across, and I'm going to extend it to that area, which also means that little area hasn't been covered either. This one back here was covered, those were covered, that was covered. So all these have been covered up until that period. And these, and then we've got another one down here. I'll mark that as well. So we might see the price bounce up or bounce down first before retracing to the other way. That may not happen tomorrow. It could take days or even weeks to play out. So we need to keep an eye on it and just be aware that those orders haven't been filled. On the intraday chart, we predominantly take long positions, but first thing we look at is any divergence. Divergence here, a bearish divergence, lower highs on the CCI versus higher highs on the price. And if we were to draw a Fibonacci in that range, take it back to the low before that divergence started, you can see it filled that 38% almost immediately after that divergence started with that bearish candle, and hit around about the 38%, then it bounced out. At the moment, the CCI is moving in tangent with the price, so no further divergence that I can see there. If we go to the back testing, what I've got here is I've started it here for around about the, that period was about the 12th of May for the stop loss approach and the average down approach. So again, you would have stopped out long positions on about the 22nd of May when the daily broke into the CCI range there, and that was around this period back here. The stop loss approach generated about 1,380, and the average down approach generated about 10,260. Now, and you would have gone long again almost the day after there, a couple of days after. And again, you would have stopped it out with a small loss potentially, and then re-entered again. So otherwise, if you let it run the whole period, you can see there the average down approach went below our baseline of 100,000, so you would have lost about $1,500, and the average down approach would have regained those positions with averaging down, and it would have made about 23,700. With the average down, just be very careful. Always emphasize it. Notice the drawdown. You always add to the positions, and if you're not following it strictly, and you notice back here as well, going long, that would have been a nice little trade to take, but then the price dropped against you. So always follow the daily, and if you want, you can also follow the hourly in this case, the smaller time frame. So if you start seeing the CCI dropping off, it's probably wise to get out of the trade if it's going against your trend. So if you're new to trading, we're now including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily trades. If you enjoy the content, please feel to subscribe to, at least on a free trial, to my Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.